The markets are going down with S&P 500 down 5.94% from all-time high and QQQ entering a correction territory with 8.71% from all-time high. Meanwhile, I am getting very excited because most millionaires are made in a bear market. The discounts are the opportunities for long-term investors, and in this video I will introduce 3 stocks I believe is a buy right now. 2 stocks are a strong buy, and 1 stock I will explain you the strategy, how can you capitalize waiting for the stock to reach a buying zone. I would wanna start this video from the interview of legendary investor Peter Lynch, dropping gems and sharing with us how to take advantages of market corrections, which is today as relevant as never before.
But you should study history, and history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means, that's a euphemism for losing a lot of money rapidly. But we call it a correction. And so 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. You understand the company, you look at the balance sheet, and they're doing fine, and you're hoping to get to 22 with it. 14 to 22 is terrific. 6 to 22 is exceptional. So you take advantage of these declines.
Starting with stock number 1, Alphabet. Google is more than just a search engine. It's a tech empire with an unshakable competitive edge. Its dominance comes from 4 key strengths: intangible assets, network effects, cost advantages, and customer switching costs. Google Search, the backbone of Alphabet. Google Search holds over 90% of market share on mobile thanks to its brand, AI-driven algorithms, and exclusive contracts with device manufacturers like Apple and Samsung. Its ad business is a money-making machine leveraging user intent to deliver high ROI ads. YouTube, a video giant with over 2 billion users, YouTube benefits from its brand, massive audience, and growing subscription business. Its strong network effect keeps users and creators engaged, making it a crucial part of Google's ad empire. Google Cloud, smaller than AWS and Azure, Google Cloud is gaining ground with competitive pricing, AI-powered chips, TPUs, and high customer retention due to switching costs. Android and Google Play, powering 2/3 of world's smartphones, Android benefits from deep integration with Google's ecosystem. Developers stick to Google Play because of its massive user base. Just a week ago, Google announced that currently search has 5+ trillion searches annually, with a trillion, or 416 billion searches per month. This is absolutely mind-blowing numbers. In addition, Google has a moonshots like Waymo, and Waymo now is serving 200,000+ paid trips each week across Los Angeles, Phoenix, and San Francisco. That's 20x growth in less than 2 years. Next up is Austin, Atlanta, and Miami. Looking forward, Google is a strong buy here with conservative projections around 11 to 10% in the next 5 years, with net income margins of 28% and PE multiple of 22, with buyback of 2.5%. When you can double your money with something as strong as Google, I think this is opportunity need to be taken by investors. The next company in the list, Amazing Zone. Amazing Zone has 4 main parts of the business: Amazon's retail business, AWS, Amazon's advertising, logistics, and vertical integration. Let's start from Amazon's retail domination. Network effects. More buyers attract more sellers, reinforcing marketplace dominance. Cost advantages. Scale-driven cost savings, logistics efficiency, and vertical integration, own fulfillment, delivery, and private label brands. Intangible assets. Brand trust, AI-powered personalization, and technology-driven operations. AWS, the profit machine. Switching costs. Enterprises relying on AWS face high costs and risks in migrating elsewhere. Cost advantages. Economies of scale, proprietary semiconductors, and industry-leading efficiency. Intangible assets and network effects. Advanced R&D, developer ecosystem, and software integrations make AWS indispensable. Profitability. AWS generates 60 to 65% of Amazon's operating profit, while contributing 10 to 15% of total revenue. Amazon's advertising power. Intangible assets. Proprietary data on consumer behavior is unmatched. Network effects. A competitive marketplace where brands vie for ad space, driving profitability. Future growth. High margin business comparable to Facebook's advertising model. Logistics and vertical integration. Amazon's control over its supply chain, from warehouses to delivery, further strengthens its moat, driven efficiency and cost advantages. Amazon recently was performing devices and services event in New York City, and they shared latest AI advancements and introduced Alexa Plus, next generation AI assistant. For me, Amazon is a no-brainer, with conservative revenue estimates of around 9% in the next 5 years, with the operating cash flow margins of 23%, and with the price to operating cash flow of 20, Amazon has upside of 117% over the next 5 years, or over 17% CAGR from here. To double, you need to buy Amazon at $217 per share. Meanwhile, currently Amazon closed at $199.25 per share, which makes Amazon as a strong buy. For me, Amazon is my top 1 position in my portfolio with 26% allocation. Why I am betting so big on Amazon? I believe that the next stage in AI revolution is robotics, and Amazon is the largest company in the planet by the revenue. Recently they overtook Walmart. So currently the revenue of Amazon is unmatchable by anyone in the world, and I believe that retail business will have expanded its margins significantly because of robotics, improving efficiency, and cutting expenses. That's why for me Amazon is top 1 in my portfolio, and this is a big bet for the next 5 years. Coming to the third company in our list, and this is Hims & Hers. Hims & Hers is smaller company comparing to Google and Amazon. Those are blue chip stocks, and this one is a moonshot. This is a smaller company which potentially could 5 to 10x from here. Hims & Hers building a strong economic moat. Hims & Hers is carving out a powerful space in a direct-to-consumer telehealth, leveraging brand strengths, technology, and cost advantages to stand out. Brand and customer loyalty. Hims is trusted, affordable, and discreet, especially in men's health, mental health, and skincare. Subscription model locks in customers, ensuring recurring revenue. Scale and cost advantages. As one of the largest telehealth platforms, Hims enjoys lower customer acquisition costs and better supplier deals. Vertical integration, owning fulfillment, pharmacy, and distribution drives efficiency. Seamless online experience with licensed providers keeps users engaged. AI-powered health solutions are personalized care improve the patient experience. Competitive edge in a booming market. The telehealth industry is set for the rapid growth, and Hims is expanding into new categories like weight loss and primary care. Unlike traditional healthcare, Hims removes friction, making it easier, faster, and cheaper for patients to get treatment. Hims & Hers have outstanding revenue growth of 95% in the latest quarter and 75% plus gross margins. And also, Hims can get the payback for the acquired customer less than 1 year, which means basically that they can spend money on marketing, acquire the customer, and get the money, a return on investment which they spent to acquire this customer is in less than 1 year. For the outlook for the next quarter, HIMSS is projecting $2.3 to $2.4 billion, which is 56 to 63% year-over-year growth with adjusted EBITDA margin of 12 to 13. And in the long term, HIMSS is projecting 20 to 30% long-term adjusted EBITDA margin and gross margin north of 70%. In my conservative model, you can see that I put a revenue growth of 15%, net income margin of 25%, which management just told us with adjusted EBITDA of 20 to 30% for the long term. And for the PE, I'm putting 22%. I feel this is relatively conservative with this kind of margin profile and also with the revenue growth of 15 and the 90% plus recurrent revenue. I'm also estimating the dilution of 4% every single year, and with these conservative assumptions I'm getting 140% in the next 5 years or almost 19% CAGR over the next 5 years. If you believe that net income margin of 25 is too optimistic, you can assume that net income margin of 15 makes more sense. If this is the case, the HIMSS will have upside of 43% over the next 5 years, and to double your money on HIMSS you need to buy HIMSS at around $26 per share. And how can you make money while you're waiting for HIMSS to reach $25 to $26 per share, which by the way has also technical support at these levels? You can sell puts, and by selling puts you can generate additional income while the price of the company is reaching your buying zone. This is the strategy for the HIMSS will be working very good because the volatility of this stock is very, very high. This is the high beta stock, and for the high beta stocks the premiums on selling calls or selling puts is very high. That's all for the video, and if you're watching until this time, I so much appreciate your time. This means a world to me. Click that subscribe button if you feel that you get any value of this video. I hope you enjoy it, and I'll see you in the next video.